I bought the bank and I bought the jazz.
I buy apartments, I send checks.
Young billionaire went undercover, help y'all discover who did it best.
Just bought 2 choppers, can't wait. They see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heels on ills, deals. Look who went from meals to bills. It's eat what you kill when you're in the field. In the pipeline overflowing, I don't drip, I spill.
We don't seek balance, nah, we want extraordinary. If you really knew my dreams, it'd be more than scary. We got more to spare, ain't no shortage, baby. Winning by the chopper and another for my lady.
Talking about the bird and the strap. Say the word and she handle that.
Fully loaded, put it at the target, and you know we let it off every man. Got money, who got my back? You can never get it if you never ask.
Big bags, legendary swag. Only one thing better than cash.
When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow.
When I walk through, no I won't do, no I won't do, no I'm talking to, not to, you know about to do, what? Walk in that door.
All right, I'm going to stop sharing here. Jerry, you can share your screen. Hey guys, what's up? Let me know how your day has been going in the chat here while we admit everybody. Everybody seems to come in at the same time. All right, let's get ready to start. Happy Wednesday, everybody, and welcome to the Multifamily Freedom Chasers Wednesday night financing Zoom. My name is Shelly Miles. I am a commercial mortgage broker and the co-founder of our brokerage company called Adventure Commercial Capital. Now, what our company does is connect real estate investors like yourself to lenders. We have the skills to understand what you need because each deal is unique and each and we have the skills to understand what you need with your deals. I will go ahead and give it over to Mr. Jerry Miles. Go ahead. Can you hear me? Can anybody hear me?
It's
Yes.
me. I had mine muted. We can all hear you.
Okay, for a second there. Is anybody hearing me? My screen was on just
Well,
now,
cool.
so I was distracted.
Welcome everyone. You can see my screen, right?
Yep.
Okay, cool.
We just
So-
got all this income of people just now when I was like,
Yeah. Yep. So I am Jerry Miles, co-founder of Adventure Commercial Capital. I'm a commercial mortgage broker. And hopefully, I see a lot of new names. If you are new, why don't you put a 1 in the chat if you are new here to the call tonight? Let us know. Jose, all right. Cool. Jose says,
whoa, we've got a lot of new. Oh, Michael, Mr. Hawkins, you're not new. He's trying to trick us. Chris, Jennifer, Miranda, Joanna, Renee, Jose. Welcome, guys. I'm glad you guys are here. Mr. Hawkins.
JJ entered.
Yeah, I see a lot more people. Wow, there's a lot of new faces here. Where, how did you guys hear about us? Let me know in the chat. You can go ahead and start while everybody.
Yep, I will. I was trying to give
Facebook
JJ
group,
co-host. Okay.
same group, email. Wow, good. Wow. You can call with Jerry. Awesome.
All right. Well, cool.
Facebook group. Oh, JJ, stop it. I'm just reading. I'm not looking at names. From the Fast Pass program. Yay, we have somebody from our Fast Pass program. That's awesome.
Awesome.
Miranda. Good to have everybody. If I missed your name, I apologize. Maybe I couldn't pronounce it. Sorry.
All right. So today's agenda, we'll go over the community ecosystem a little bit, introductions. I'll introduce ourselves, and then we'll give maybe, I got a lot to cover today. We'll maybe give two people a chance to introduce themselves. We'll go over the current debt market, and then our main topic is understanding DSCR. So, and then we'll do a question and answer at the end. We try to keep these calls to an hour. Sometimes they go a little over, but we'll stay on for a while and make sure we get everybody's questions answered and things. So, if you are new here to MFC, welcome. This is a community like no other, the Multifamily Freedom Chasers. We have four weekly calls that are all free. We also now have a Fast Pass program that is made to jumpstart your real estate investing journey. That is a paid program, and those are on other times. But on Mondays, we have alternating calls, alternating Mondays. We have Trevor, and he does the activation Zoom, alternating with Iffy and Bibi, and they are doing asset management, and then just talking about running deals and partnerships and teams and all that kind of stuff. You have me and my wife, Shelly, and our son, JJ, that take care of this call, and it's alternating with Kevin and Ed, and they are commercial real estate brokers. Bibby and Iffy are active buyers. I think they've bought 2 deals here in the last 6 months. Kevin and Ed are buyers. They bought a deal, 120 some units in Florida just a couple months ago. Trevor is an active investor. Everybody on here, my wife and I, we are full-time in the real estate business. So the people that are presenting and doing things on these calls, we're all qualified to do what we're doing. So plug into the community, and these are all the different places you can find the Freedom Chasers community and connect with other people. And who are the Miles? That is me and my wife Shelly and 2 of our boys, JJ and Jordan. We are commercial mortgage brokers. We have been in real estate investors for about the last 10 or 11 years now. We've been running a construction business for the last 20 years. When we started investing in real estate, we ran into some different lending brokers and things, and I learned that you can't always trust what they're saying. We were running into some issues with some guys that were kind of shystery and overcharging and things like that. And I told my wife one day, I said, I think we could do a business like this, charge people fairly, treat people right, be a service to people instead of just trying to get in there to collect a fee. And so that's what we did 4 years ago. We started Adventure Commercial Capital, and going strong and closing deals. So we're here to serve the real estate investor community with our business. So, and if a couple of you'd like to raise your digital hand, you get about 30 seconds each. And tell a little bit about yourself. JJ, go ahead. JJ is our son and helps us run this. So go ahead.
What's up? Yeah, I'm a bit out of breath because I just worked out. But yeah, my name's JJ Miles. I am a YouTuber. I've been doing it for about 2 years, and I know technology and stuff. So I help my parents with the Zoom call. I help with different aspects of that, like moderating the chat and you know letting people in and out, and doing different stuff like that. So that's me.
Cool. Thanks, JJ. And I'll brag on JJ a little bit.
Yep.
He's getting ready to graduate high school, and he is now a professional YouTuber because he's getting paid for it. And but he's going to be the valedictorian of his class this year. And we actually went up to school today because he was playing the championship match of a chess tournament that he was in and won today. So we're proud of him. He's a hard worker and a smart kid. So, but he doesn't like being called a kid. He's ready to be an adult. So, but if no one else wants to introduce yourselves, I want to encourage everybody to put your information and things in the chat. We have had people that have done business together because they have met each other on this call. You never know who you're going to run into. I know people personally on this call that are real estate buyers. They've been buying for years. And I know other people on here that are beginners, and some of you guys can connect with each other and bring each other deals and do business together. So if you're a contractor, if whatever it is that you do, put the information in the chat and let everybody know. So
Also, if you're not a part of the MFC Facebook group, I'm just putting the link in the chat. You guys can grab that and be a part of the Facebook group. You'll get all the event updates and notifications and all the good stuff. So you'll know when all the free calls are.
awesome. I'm going to turn my phone down. I don't know if y'all can hear it, but it's been going off since we. Okay. So the current debt market, where are the current rates? The federal funds rate, we're in May now of 2024. And, by now, if you would have been listening last fall, we should have had 3 rate cuts by now. And we haven't had any. So, the federal funds rate is still, at 4.25 to 5.5. And I was on and trying to change these today, the 10-year and 5-year treasury, and I did not change them. The 5-year, I think, was right at 4.7. The 10-year was about 4.65, 4.67, something along those lines. But the treasury rates determine the rates we pay on mortgages. The treasury rates will usually determine the long-term rates, when you're looking at long-term debt. If you're looking at, bridge debt, construction debt, things like that, we'll look at different things for that debt. We'll look at, the Bank of America prime. We'll look at, SOFR, different things like that. And you can always ask a lender if you're talking to somebody and you want to know, where their rates are. You could say, hey, what do you base your rates on? And, they might say, we base it on, Bank of America prime. I think it's at 8.5 or so, or 8.25, something like that today. And they'll say, and we're usually 3 to 5 points over that. And so, that would put you at, 11 to 14% or 13% or whatever it is. The 10-year and the 5-year treasury, when we're looking at like agency debt, Freddie and Fannie for multifamily, those are going to be based on the treasuries. If you're looking for 5-year debt, and you're at that 4.6 range with the treasury, you're going to be, 1.5 to 2.5 over top of that. So you're going to be, 6 to 7% on your rates when you're looking at Freddie and Fannie. So, and that's you can look at the 5 and 10-year treasury if you're looking at different different things. You can look at those and kind of determine your rate that way. Just something else to note, if you're looking at, this is Freddie Mac small balance loans. These go, the small balance with Freddie Mac goes 2 million to 7.5 million. If you're at 7.7, 7.8 million, you're in that conventional, loan amount. Your rates are going to be, quarter to 3/4 lower than what these are showing. So if you're over that 7.5 million, you will get a little bit better rates. Being in the small balance, the rates are just a little higher. But these are updated as of April 23rd. So I don't know if you want to take pictures and things. And I'm going to go over here, and this is the Fannie Mae. These go up to 6 million. 2 to 6 million, 2 to 6 million, over 6 million, you're going to get a little better rates and things. And if you're on here and you've been shopping for real estate, everybody knows we've been in kind of a stagnant market over the last year and a half to 2 years now. Since the rates started kicking up, things have kind of really slowed down as far as buying and selling. Sellers that have been able to hold on have held on, and they're not selling. Because their valuations and everything else, if you're looking at commercial real estate, the valuations on most commercial real estate have really been hurt by the rates going up and by inflation. Inflation has made insurance rates go up. It's made taxes go up. So the valuations of properties have been hurt because of it. I'm seeing a lot more deal flow on our end right now. So it's telling me things are starting to break free, as they've been hearing the Fed talking about lowering rates for the last year, and we haven't had any rates lowering. Some of the sellers are starting to kind of realize, hey, we're not going to be bailed out by lower rates. We just got to go ahead and take our losses and sell. And so I think some of that's happening. But there is a lot more opportunity coming to the market. We're right here, I think, at the beginning of a major real estate correction. When it comes to commercial real estate, I don't know if that's going to happen as much residentially, but definitely in the commercial space, as we have all this debt maturing. People that are in 3% and 4% interest rates. Those terms on those rates are going to end, and they're going to go to adjustable. That's what it means when you hear, well, these rates are the debt is maturing. Half a trillion, in 2024, half a trillion in 2025. We've got $2.7 trillion worth of debt maturing by 2027. And I think the actual numbers are going to be bigger, because over the last year and a half, debt that has matured, that hasn't sold off and things like that, a lot of people have gotten extensions from their lenders. They've bought rate caps, they've done different things, and these are going, and they're just pushing they're pushing the ball down the field and hoping that the rates are going to come down. And as like I said, they're going to start, as this extension period comes up, it's going to make that 540 billion that's mature in 2024. It might make it 700 billion or 800 billion because of all the stuff that matured the year before that didn't sell off. So there's going to be a lot of things going on over the next, year to 2 years, I would say. And Nathan, I see your hand raised. Go ahead, man.
So thank you for this data. My question was, do you see a specific market or a specific class of properties which will not be affected by this and will continue to see a lot of demand in that segment? Or where the deals would be would be still there?
Well, I mean, as far as yeah, I mean, there's people that are not going to be in a bad way, as far as owners. The thing that is making this a buying opportunity coming up, when I say there's going to be a lot of opportunity coming up, it all depends on the position of the property owners. I mean, there's property owners out there. If someone has bought a property in the last 5 years, a lot of them have bought, on 2, 3, 5 year debt, and that's going to mature. You know, when people were buying 3 years ago, they were buying on 3 and 5 year debt because they were planning to exit the property in 3 years or 5 years. And so these people that bought on that shorter term debt, those rates are going to change on them, and it's going to really affect their cash flow. And when it affects the cash flow or the LOI or the NOI, it affects the valuation of the property. So just as an example, I've told about a bunch of different deals. I mean, shoot, there's been so many deals that have come to me recently that the owners are just hurting. There's an owner in Florida that is I've just talked to recently. They owe 19 million on a property. They bought it for 22 million. They owe 19 million. They got bridge debt because they got 2 year bridge because they plan to remodel some things, and they were thinking this property was going to be worth 30 million, and they were going to sell before now. Well, right now they're needing to refinance because they can't sell for the same price that they bought it for originally because of the cash flow with the new debt. So the most we can refinance them for is 14 million in today's market. They were going to be able to refi for 20, 22 million is what their plan was. Pay some of the investors back and all these things. Well, they're just trying to hold on right now and not lose the property and not lose all their investors' money. There are multiple deals in every market that are in the same situation. People that just happened to buy 3 years ago, and then a year later, the market totally turned upside down on them. There's so many stories like that I could tell about of borrowers that we've been talking to recently. And your all's job as investors is just to continue pounding the pavement and trying to find these sellers. These sellers are out there. They're gonna fight, and they're gonna do everything they can to sell these properties for what they got into them, and so they don't lose their investors' monies. I mean, if you guys are syndicating and things, I mean, a lot of your investors are family members and friends and coworkers or whatever, and or they're friends of friends, and they're your network. And it'll make Christmas time awkward if you lose $1 million of grandma's retirement money, and so these people are doing their best to hold on to these properties because they don't want to lose their friends and family's money.
In that case, as a GP or as a primary investor in that deal where it has gone underwater, aren't they trying to do another capital raise and dilute the share of the existing partners? Is that an option they have on the table? Is that what people are trying to do?
Yeah, there's some of that going on, but I mean, like in this case, they would have to raise another, what is it? I mean,
5 million.
Another $6 million.
Yeah, 6 million.
Yeah.
Yeah.
So I mean, some of those
That's
things.
a big dilution.
Yeah. Yeah. And so, I mean, you've now, you're hurting so bad, and you've encouraged all these people to invest to begin with. And now you're saying, hey, your money might be gone. Why don't you invest another 100,000 with me or another 500,000 with me? That's kind of a hard sell.
It is. Got it. Thank you.
Yeah, for sure. So that's it with the current market update. We can take more questions later about that. If y'all have questions later about that, go ahead and feel free. But we'll go ahead and get on with the main topic. Understanding DSCR. You know, I did this topic about 6 months ago or so, probably. And a big reason why I did this topic is because, there's a lot of people that don't know what DSCR is to begin with. Now it's a whole loan product, in the 1 to 4 unit space. So I just wanted to kind of talk about DSCR. We'll talk about what it is, what it means, how to figure out what the DSCR is. And then I will also, at the end, I will talk about DSCR loans and our products that we offer. I'll even show you a quote that we put out recently for a DSCR loan. So, excuse me. So, DSCR is debt service coverage ratio. It is the ratio or formula that banks use to measure cash flows ability to pay debt obligations for commercial properties. This is also, for businesses that are trying to borrow money, they're going to look at the DSCR. They're going to look at your debt service coverage ratio. What kind of income does this business have to cover the debts, to cover the debt payments? So in comparison to residential real estate that uses debt to income or DTI, business and investment real estate loans use DSCR. So if you're buying it to live in it, you're going to use debt DTI. If you're buying it as an investment, you're going to use DSCR. So how to find the DSCR? So what you're going to do is you're going to take the yearly NOI. So the NOI divided by the yearly debt service or mortgage payment. So DSCR is a net operating income. To get your net operating income, you take all of your income and minus your expenses, and that is your net operating income. And then to find our DSCR, we'll just divide it, the NOI divided by the yearly debt service or mortgage payment. So if your net operating income is $15,000 a year, or $150,000 a year, or $1.5 million a year, your debt service is 12 or 120 or 1.2 million a year. You divide those and you're going to get your 1.25 DSCR. And really, in commercial real estate, unless it's a bridge loan or a short-term loan or something, that's kind of going to be your sticking point is 1.25, especially multifamily. There are certain cases where we could go to a 1.15. If we're doing like if we're doing a SBA loan or USDA or something like that, generally 1.25, 1.35, 1.45 is going to be the debt service ratio that we're going to need. So, any questions on that at all?
Yeah, Jerry, I have a question. We have a debt broker that's trying to get a DSCR loan for us on an eightplex.
Yeah.
And he was talking about how he's done DSCR loans for less than one. Do you know much about that?
Yeah, you can do that. Yeah, there's lenders to do it. I mean, it happens.
I guess my question would be why would they do that, and what's their reasoning?
I really can't speak to that because it doesn't make sense to me how they do it. I can't imagine them doing it more than once or twice for a borrower. Maybe, they might, just do it on assets they really like. And then they might be, there is lenders out there that, scoop properties up when people can't perform on the properties, and that might be part of their business plan too. But I mean, there are lenders that do that, and as far as I know, I mean, there's some reputable ones, but I don't understand their business plan behind that. unless you have a, A-class property, a really nice, custom home or something in a nice market that doesn't cover the debt payments. The tenants don't cover the debt payments, and they might just trust that borrower may be a doctor or, a high income earner that they trust they're going to be able to make the payments anyway.
Okay, got it. Quick question. I know that you, based on our call last week, you said that you wouldn't be able to do anything for us for a construction loan on property in a rural area in
Yeah.
Kentucky, but would you be willing to do a DSCR loan on a property in that same rural area? Or is it?
I don't have, we have, I've got 6 or 7 different DSCR lenders that we can work with. I'll ask around a little bit. I know I'm 90% sure that I wouldn't be able to, but I might have somebody that's interested in lending. I've got 2 that I'll bring it to that might be interested. The others will be hard no's. But yeah, there's a chance I could get it done.
Okay. All right. No worries. I just kind of feeling that out there.
So
Thank
if you
you.
send me the address and kind of well, I'll tell you what I need on them, and I'll let you know tomorrow if we can do it or not.
Okay. All right. Thank you.
Yeah, for sure. And I see Alicia, sorry.
So right, so you were talking about the DSCR magic number is 1.25.
Yeah.
So it's 1.25 and higher
Yeah.
that needs to be seen
Yeah.
because that is considered what, safer?
Yep. So if they're what, like 25% higher, income to the debt service, and that lets the bank feel comfortable with you being able to make those payments. It's the same idea as like the bank does with debt to income ratio. They want to see, that you make a certain amount over your mortgage payment, to make sure that you that you have money to cover your payments. It's the same thing with commercial real estate. So does that answer your question?
Yes, it is.
Okay, good. Good. And I see your hand up, Shelly.
Yeah, someone asked, will a DSCR loan need to be a higher ratio compared to a conventional loan?
No. The the DSCR loans, if we're talking like the smaller properties where we have the product called a DSCR loan, it'll be about the same. A lot of them will even do better than the 1.25. I mean, a lot of them will go 1-to-1, all day long if it's a nice property in a nice location. The 1.25, would be kind of a worst case they would go to for a DSCR loan. And I say, DSCR is used to figure all the loans. Now, when I say DSCR loan, that just means the smaller loan size, on singles to, sometimes 12 units on the smaller side there. So, and
I
so,
hope that answers your
yeah,
question. I got one more question. How
yeah.
are you calculating NOI and DS?
How am I calculating
NOI to
NOI?
debt service.
Yeah, so NOI is just all of your income on the property. So all the money coming in, minus all of your expenses. So now your
You can
CapEx
probably slide back to
expenses.
that one slide.
Yeah,
Sorry.
your CapEx expenses, like if you have new roofs, you got to do things like that. That doesn't count as part of your expenses. Those are CapEx expenses. Those one-time costs are part of your CapEx. So any office staff, any, maintenance on your yards, snow removal, insurance, taxes, all those expenses that are always there. Those are going to come off of your total income, and that'll give you your NOI, your net operating income. And then we'll divide that by your yearly debt payments. So if your payments are, $10,000 a month, you divide whatever your NOI is by, 120,000. So I hope
Hope
that
that answers your question, Tanya.
So you'll hear people, you'll hear lenders say, oh, well, we can lend, 80% of this, we can give you a loan to value of 80% or 65%. And like with Freddie and Fannie, we can go up to 80%, loan to value if our DSCR meets their requirements for that deal. So Freddie and Fannie, depending on the location, depending on the borrower, they're going to require different DSCRs. So if you have a repeat borrower in a strong market, we could get as low as 1.2. If you've got a newer borrower, maybe buying a bigger property than he's ever bought, or some along those lines, and then we're in a secondary market, or maybe a market that has more crime, they might require a 1.45 DSCR on that deal, just because the deal's harder to run, or they're not as comfortable with the deal. So, but they'll say, yeah, we'll lend 80% of loan to value, but we need a DSCR of 1.35. So if you're at 80% and your debt service is at 1.15 or 1.2, you're going to have to lower the amount. They're going to lower the amount they give you. You might be at 70% or 65% loan to value because the DSCR is, stopping your loan proceeds because they need to get to that DSCR, that their target DSCR. So hope that answers the questions. So when you hear people talk about what is a DSCR or a DSCR loan, it's one of those kind of, I guess, sales pitches or whatever, it started out as, so much to where I was like, one day I was there and I was like, you know what, I'm going to commandeer a Facebook page called DSCR Loans. And so if you're on our DSCR Loans Facebook page, I said, hey, I'm going to do that and drive traffic to our business that way. And so I said, so many people are talking about these DSCR loans, I'm going to go ahead and take that name on Facebook. So usually it's 1 to 4 unit properties, sometimes up to 9 units. We can get up to 12. These are non-owner occupied. Very, very simple underwriting in comparison to most multifamily or office or hotel or whatever. Yes, we can sometimes, I forget, it was Matt, I think, talking about the negative DSCR on some of these. Yes, we can go to a negative DSCR on these on certain occasions. An example of how to underwrite these. We need total yearly income minus the annual taxes and insurance and minus debt payments. And if we have a positive income, usually if they're in it's market driven. If it's in a market that we can lend in, then we can lend on that property with a DSCR loan. That's the only, if you hire a property manager, if you hire a lawn care guy, all these things, the lender don't care about those. All they care about is annual taxes, insurance, and debt payments. So, and that's the only things that they'll look at when they're figuring these. And I'm going to pull up one here. This is for a customer. She's been on these calls, but I don't think she is right now. But I'll do that to kind of hide her address. So can everybody see that? This is a quote for a cash out refinance.
I'm not sure if everybody else is seeing it, but I'm not seeing it.
Okay, yeah, I hit it. That's good. Oh, you're not seeing my quote here?
No,
At
I'm
all?
seeing your screen.
Oh, okay.
I'm seeing your slide.
Oh, okay. Gotcha. Well,
Minimize your slide.
give me a second. All right. I'm going to try this again. So there we go. Can you all see it now?
Yeah.
Okay,
Yes.
cool. So this is a property. I got a quote also with an 80% loan to value because our lender can do 80% on this one. It took the rate from 7.2 up to 8% though. But this is just an example of what a quote would look like on something like this. Property value at 575,000. You know, we see the rental income, taxes and insurance. There's no HOA. And then we could, 75% loan to value gets you to 431, 250, 70%, 402, and 373. The rates are pretty good in comparison to others I've seen recently. This borrower's got a really good credit score, which helps a lot. Cash due at closing. They owe some money on the property now, but it's on a bridge. They're wanting to get out of the short-term bridge. All the different fees and everything, and all the legal stuff. So hope that helps, a little bit just on what that looks like. And can you see my other screen now? Cool. All right. So we're open for question and answer. Anybody has any questions? Go ahead and fire away on them. Things that we need for a quote. Alicia?
Right. So do you have any 30-year loan products, and what are the interest rates for the 30-year DSCR loan products?
Yeah, that was a quote that I just showed. That is a
Oh, I saw at the top it was a 5-1, like an arm, but I'm
it's a
looking for a
30.
fix.
Okay, yeah. So if you
Oh, could you show it again? Because I saw arm for some reason.
yeah, it's a 5-year term. So in 5 years you would have to refinance, but it's amortized out for 30 years. So it's a 30-year loan. If we can take this same loan and take that into a 10-year, we could do an interest only for 5 years. We could do a 30-year term, full fix for 30 years. Now, when you go full fixed for 30 years, that's 7.2 and 6.9. I would say figure adding a whole point, a whole other interest point, 100 basis points to those rates. So you'd probably be 8.2 and 7.9 on the rates. When you take it out to the 30 years, the 5 years, what I use. And the reason I use that, if you look down here where it says prepayment penalty, these are what I usually quote because the prepayment penalties on a 30-year are a lot harsher. I mean, you're going to be 5 points after 5 years to refi the loan or to sell the property. You're going to have to pay 5 points to the lender to do that. So my suggestion to everybody, hey, do the 5-year term. Now in 5 years, or if you wanted to refi in 3 years or 2 years, you're going to have a little bit of a prepayment penalty, but I mean, you lock in at 8.2 for 30 years. I mean, this borrower here has got an 800 credit score plus, like 816 or something, I think, and that's getting her to 7.2 to begin with. So if you have a 700 credit score, that 7.2 is probably going to be a 7.7, 7.8. So you're going to be almost 9% if you have an average credit score. And then you're going to lock that in for 30 years. I wouldn't recommend people doing that, because, things happen and you might want out of the property, and you don't want to have to pay 5 points to get out of the property. So does that make sense?
Yes.
Yeah. So, I mean, if 2 or 3 years comes down the road, let's say interest rates drop quite a bit, and you want to lock into a 30-year because you're like, I'm never selling this place, whatever, yeah, I mean, that's your decision. But, to me, um, in this market, I would say 5 years and then see what's going on in 5 years. So, now this is not financial advice. I don't know if I need to share that, but, I'm not a financial advisor. I'm not giving financial advice. I'm just telling you, like, in my opinion. So, needed for a quote, if we're looking at commercial real estate, T12, rent roll. If we're looking at, hotels, we're going to need star reports. There's all these different things. This is mainly for, your average commercial real estate or your multifamily. I see you, Jason. What's up, Jason?
Hey, how's it going?
Good, man. Good to see you.
Yeah, you too. It's been a while. Hey, so on the DSCR loans, the fourplexes or
Yeah.
the 4 units, what are you seeing right now? Like what are the numbers that you're seeing that make sense right now as far as, kind of what's closing? So I mean, I'm looking at a lot of fourplexes right now. My goal is to get five deals by the end of summer.
Yeah. Yeah. I mean, if it's cash flowing, um, and you have the money for down payment and things like that, I mean, we can get them closed. If it's in an area that has a high population, population city center, the area you live in, if you're looking in that area, I mean, we can do those all around that area. I mean, you got a big area there where we can fund those deals, if you're looking, um, in the middle of Kansas, we might not be able to fund the deal for you because of population and things, hindrances. But if you're looking in Kansas City, you can fund pretty much all over Kansas City. Kind of the same everywhere. If you're around jobs, lenders want to lend on those deals. You're around jobs, you're not in a high crime area, we can find help for it. So,
And what's the best way to leverage? I was very much involved the first, probably 20 minutes of the call with the debt market right now, where you've got Fannie came in, hey, 5%, you can 5% down, you can get in. You got your first time home buyers 3.5%. But how do they qualify for DCR loans with minimal down, but still having enough of that DCR, like you were talking about, less than 1 or 1.0.
yeah. Yeah. So, when you're looking at the Fannie deals, those are owner occupied deals.
Hmm.
So they're looking at debt to income on the person that's buying. So they're going to look at their debt to income, and then they will allow you to add a certain percentage of your income on the property to your income to help out with that debt to income ratio. So it's a really nice program for somebody that's wanting to move into one. When you're looking elsewhere, as far as like with the DSCR, we can lend up to 80% if it cash flows. Um, you know, I, I know that they're available, but I don't recommend anybody getting into a deal that doesn't have a positive DSCR. Um, it's just not a good idea. So, even if you have to put more money down to get your positive DSCR, I would say that's your best bet. So, but yeah, good population centers with good jobs. I will tell you, you know, not all population centers are equal. You know, we have the city of Detroit. Certain areas are really hard to get funding in because of crime. And the city of Detroit over the last 10 years has had twice the national average in loan defaults. So lenders are a lot more cautious going into the city of Detroit. Certain neighborhoods in Chicago, lenders will not lend there because of the crime and because of very, very high default rates. I mean, there's some neighborhoods in Chicago that have 3 and 4 times the default rates on mortgages than the national average. So, you know, there's other markets, you know, certain areas of Baltimore, certain areas of, you know, St. Louis, you know, places like that, that just the lenders say, oh, you know, that zip code we won't lend in because X, Y, and Z, you know, and it's because of the default rates in those areas. So hope that answers your question. Good. And Alicia, I see you again.
Yes, my question is about reserves. So what reserves are required for payments, and then what reserves are required for capital expenditures?
On DSCR loans, capital expenditures, I mean, you know, if you have a lot of capital expenditures, you know, we would put you into, you know, like a fix and flip loan or a rehab loan.
Mm-hmm.
We would refinance into a DSCR loan. We can do, you know, fix and flip loans now. We can lend up to 92% of your cost. Actually, 92% of your purchase price, and then we'll lend all the construction money. So it
Okay.
actually ends up being less than your, you know, 7% of your cost or whatever. I mean, it's really good programs right now we have on that, and then we could refinance you into a long-term, you know, DSCR loan from there.
Okay.
You know, but on just regular, you know, they usually like to see about 6 months in the bank of expenses. So hope that helps.
Yes.
What we need for a quote for a DSCR loan is different from the others. You know, in the DSCR loan, we can even do those without a tenant present. So, you know, buying the property is just a matter of, you know, what is what is the average rent for this market? We'll figure that. But we need address. If it's a purchase, we need the purchase price. If it's a refi, we need the purchase price and date purchased and the current value. Then monthly rent, taxes, insurance costs, and borrower's credit score. From there, you know, we can get you a quote, let you know if we can lend on it or not. So what can you do today to be ready to buy tomorrow? You know, there's some on here that are new. So I always want to put this in here to let you know. Make sure your credit's in order. If you listen to a lot of the gurus, they're going to tell you, oh, you don't need credit, you don't need this, you don't need money. Credit is needed. You know, if you ever want to be able to sign on the debt yourself or to be able to sign with a GP team on a deal, you cannot have, you know, your credit below 680. You know, it's important to, you know, a lot of people might call your credit score your character score. You know, it tells whether you pay your bills or not. So you can work on your PFS, your SREO, start getting your bio together, work on raising capital or making more money. And we have a referral program. If you want to join our referral program, we'll be doing a call in the next couple weeks talking about that. We pay out money for referrals. So if you want to become a full-time in real estate, refer a couple deals to us. You know, we have some very, very, very large referral checks we're going to be paying out here in the next short while. So I don't want to announce them before they happen, but we have some big ones that we're hoping to close here real soon that we'll be sharing with everybody of referral fees we paid out that, you know, would pay more than your job pays in a year for most of you probably. So, so stay with us on that. I see your hand up again, Jason. What's up?
Yeah, I sent you, I don't know if you can do this like on the fly, but I have one I'm trying to submit an offer
Okay.
and see what you can do right now on a DCR. It's a 6 unit out here. I
Okay.
sent you that link. That's the address. Let's go.
All right. Let me see here. I have it other computer. If y'all can see
Use it
another computer,
if you.
I'll try to
I
do it
think you
on this.
sent me the link, Jason.
I sent both of you the link.
Okay.
And so I'm going to change my background.
And guys, while he's pulling that up, next week, if you show up, I will give you, it's too late now, I'll give you a little tip on how to boost your credit score.
Other computer here. I'll go ahead. Do you want to go through the rest of the slides there while I do this?
Sure. Yes. I'm finishing typing up something here. Okay, let me see where we are. Yes. Oh, so, okay, next week, we are having, is everybody seeing my screen? Let me share my screen.
We don't see it right now.
Gotcha. Okay. How about now?
Yep.
Yes.
So next Monday is our next MFC call with Trevor Walker, and his guest speaker is Alex Lovely. I'm guessing lots of people know Alex Lovely. He's going to be on there. He's pretty good. And then here is our MFC Zoom calls that we're having every week. So again, it's alternating Monday with Trevor and then us, and then Mondays is Trevor and BB, and Wednesdays is us and Ed and Kevin. And I think I shared the Facebook link. If you guys are not a part of that, I'm gonna share it again here. Dude, when I'm sharing, all of my stuff goes in different places. I don't know where anything is. Here's my chat. Here, I'm sharing the link again in the chat, and you guys can grab that, and you guys can get the replay from tonight on there, either tonight or tomorrow. They'll post it. And that's it. Here's our contact information.
And real quick, Jason.
I already put it in the chat as well.
Yeah, I don't have the email, Jason.
I sent it via chat.
Oh, via
It was
chat.
it was a link via chat.
Oh, in the chat here. Okay.
Yeah.
Okay.
Sorry about
We
that.
also have, MFC also has a WhatsApp chat. Go ahead and scan that QR code, and it'll take you directly to the Freedom Chasers WhatsApp chat, where you can connect with everybody all day long, 24/7. I'll give you a few seconds. I'm waiting on here to see if I see anybody. So if you're new, I'm looking out for you. Our next call is May 15th, and our topic is going to be how to prepare for a commercial loan. Good stuff, guys. Good stuff. Okay. We have a verse of the week. Did you change this?
Yep.
The point is this. This is 1 Corinthians 9:6-8. The point is this. Whoever sows sparingly shall also reap sparingly, and whoever sows bountifully shall also reap bountifully. Let each one give as he has decided in his heart, not grudgingly or under compulsion, for God loves a cheerful giver, and God is able to make all grace overflow to you, so that by always having enough of everything, you may overflow in every good works. That's a good one.
So Jason, what is the rental and monthly rent for all the units together?
While they're working on that, I will leave this here so you guys can join the group. I am in here waiting. Yes, I see somebody joined.
All right, so monthly is gonna be 12,755.
Okay. So that would put us at 12,755 times 20, so 153.
Also, if you scan that QR code, it'll take you straight to Jerry's Hi Hello card. You'll get all his information on there.
So your annual insurance cost and taxes,
Okay. I should probably have that for you, huh? Let's
well, I'm gonna
see.
put annual insurance at 12,000 a year. And I'm gonna do the taxes at 12,000 a year, just to guess on it.
Tax is gonna be 31,
31, okay,
and let's use 6,200 for insurance.
okay.
And it's a 3 million purchase price.
Yeah. And
We've got about $2,100 a month of other income as well.
okay. All right. It is calculating. We'll do. It's got some things up right now but it's showing. If y'all can see, you can't see my screen, but it's showing.
You can go ahead and share screen.
I'm on a different computer from it. It's showing a loan amount of 2.3 million on a 3.1 million purchase, 75%.
2.3, you said?
Yeah. Interest rate right
Okay.
at 8.1. If you jump down to 70%, it gets to 7.8, and then at 65%, we're at 7.6.
Yeah, see, that's where these things just don't make sense. I mean, we got to come in $700,000 down,
Yeah.
and that's the story of my life out here.
Yeah, and that's I mean the market's rough on all fronts right now with multifamily. It's hard to find deals that pencil out. With the smaller ones like this, it's hard to find them that pencil out. And then like here where we're at, there's a lot of properties you can buy, that'll pencil, but they're not areas you want to own it. you
Right.
know um It's just, your average house in your working class neighborhood, and even in our area here in Cincinnati, they don't cash flow no more. They've,
Well,
You're in
our personal
California, right,
resident,
Jason?
yeah, and the unique thing, working with Joe and Maria over there, we throw solar on this, we're getting an extra $2,000 a month, just bottom line NOI. We got 2 more units we can throw into there, so the business plan would be there to run it for the next 12 to 18 months, but 500,000 a door, it just still is tough to commit to that.
yeah, yep. What is the monthly rent on one of those units at 500,000?
That's 24. And they're getting it.
What?
They did. I mean, this is a complete. They've done 4. Well, the 4th will be delivered, completely turned. And then there's 2 that are going for 1,700. So there's a huge lift. But again, being in California, it's almost like you got to pay them quite a bit just to get out, and 50,000 a unit to do the same kind of work that they've done. It's like, to come in $600,000-700,000, I might as well go put that and go make 7-8% as an investor.
Yeah, and when you're in, there's people putting that money into those properties because they want to own the property, and they maybe have a higher income, or have cash from something else, and they just need a place to put their money.
Yeah.
That's most of the real estate investors in California. They're looking for a place to park money, and looking for the tax benefits. So
Yeah. So if you guys know of anyone, $500,000, get some nice depreciation, accelerated bonus depreciation. It's a
yeah,
great place.
yeah,
Paying you 5%, day one. So, but yeah, it's tough. And I did submit the LOI on that deal out in Arkansas, but I think they wanted to go with someone else. I'm like, all right, when it falls through, we'll let you know. But I think that was the one you gave me 2.1 on.
okay.
Yeah.
Gotcha.
So we
Right.
offered 2. I think 2. Yeah, I think we offered 2.8 on that one.
Okay, cool.
Yeah.
Cool.
Yeah, man. We're 2024 is gonna be the year, so we'll
Yeah.
just keep on.
Yeah. Well, cool. Well, it was
All
good to
right,
see
guys.
everybody. Glad to see everybody on
Our
here.
next-
Go ahead.
Yeah, glad you guys. If you guys find value in these calls, just let us know in the chat. Let Jerry know in the chat if he's adding value to your real estate journey. And we will see you guys in 2 weeks, if not on some of the other calls. Again, May 15th is our next call, how to prepare for a commercial loan. And don't forget to join, because I will give you that tip on how to boost your credit score a little bit. Not a lot, but a little bit.
Actually, the tip you're
All
going to
right,
give them,
guys.
the tip you're going to give them is actually, it accounts for 1/3 of your credit score. So it could be a lot more than just a little bit. So
Yeah. All right, guys. Thank you. I am going to play some music and see you later.
see everybody later.
When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. Rule 1, getting money, never losing hope. But I'm broke, but now I'm living adding digits, comma zeros and some decimals.
And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested dough and I let it grow.
Benjamins I got a pocket full. Raise your income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor down.
What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the jet.
I buy apartments, I send checks.
Yo, billionaire went undercover, help y'all discover who did it best.
Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow.
buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from meals to bills. It's eat what you kill when you're in the field. And the pipeline overflowing, I don't drip, I spill.
We don't seek balance,